Welcome to the Real Estate Asset Management Podcast, brought to you by Break of Day Capital. The show focuses on educating syndicators and apartment owners on how to build systems and manage their properties more efficiently to become a best-in-class operator. 100% straight talk. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Asset Management Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Today, I wanted to talk about our 2023 real estate market outlook. The most prescient crystal balls are right about 50% of the time, and we returned ours to the crystal shop because it was stuck on a big question mark. Jokes aside, we pay a lot of attention to the macro environment and consider different viewpoints from well-known research analysts from Lynn Alden to Peter Linneman. Peter was on podcast 136 just a couple of weeks ago, and if you haven't listened to it, I highly recommend you do. He's a straight shooter with many decades of experience. We could have talked for hours, but we kept it to about 45 minutes, and it's definitely worth the listen. There are a vast range of opinions out there that predict a soft landing to a deep recession and everything in between. Though I think with the latest jobs report, it looks more likely that a soft landing is in play. But truth is, no one really knows what will happen. And it matters less for experienced real estate operators who can stay ahead of the changing market conditions. Economic indicators like the Consumer Price Index, Personal Consumption Expenditures, Institute for Supply Management, and Purchasing Managers Index have been trending lower along with oil prices, and the Fed has been responding with the smaller rate hike of late, and potentially one more 25 bip hike coming up. The bond market is suggesting that the Fed is close to pausing with the U.S. Treasury yield curve, 10s, 2s inverted. There have been layoffs in the tech sector while the unemployment rate remains stable. There is also some relief in the supply chain with cheaper shipping rates. All are signs pointing to disinflationary and potentially recessionary conditions and should continue to cause lower real estate prices. Within our industry, there have been reports of some multifamily operators coming under duress from unmitigated escalating debt servicing costs, despite the assets performing relatively well. There are concerns that some sponsors might be forced to sell properties at a loss if we end up with a deeper recession and higher unemployment. I don't think there will be a wave of distress opportunities. I've heard that some operators are doing capital calls now to get ahead of it, and many operators with floating debt are holding distributions for the foreseeable future. There are some operators out there that are paying distributions from month one on a value add and will continue to do so even with floating debt. But passive investors, be aware that these distributions are not from cash flow, but from the money they have raised from you. Deal flow will remain slow in quarter one and pick up a little steam as the year goes on. Though I was talking to one broker at the annual NMHC in Vegas last week, and he said there were 29 transactions of 100 units or more last year in Tucson, and he predicts only 8 in 2023. That's a huge drop-off. Right now, there's a big discrepancy between sellers' ask and what buyers are willing to pay. We're typically off 10 to 20% on most deals we underwrite. We'll be patient and buy right. We believe the longer term, we'll be looking back at this period as a great buying opportunity. Some of the best times to invest are when it feels the most uncomfortable. Be greedy when others are fearful, as Warren Buffett has said. We are not economists, nor do we play one on Twitter or YouTube. While we can't control market macro forces, we have made additional adjustments to our already conservative underwriting to account for current economic conditions, the tight lending environment, slowing rental market growth rates, and higher operating costs, and staying disciplined to make offers at a price that we would provide strong returns to our investors. Sellers want yesterday's rich valuation, but we and other good operators are only willing to pay tomorrow's price that reflects economic reality. At Break of Day Capital, we only acquire deals that have the highest potential to produce superior risk-adjusted returns to our investors, whether in bull or bear markets. We have a light footprint and do not need to do deals constantly to stay in business. We've gone 13 months between deals and have bought several deals in just a few months by staying true to our highly selective buying criteria. Multifamily real estate continues to be one of the best hedges against inflation, while being resistant to recessions when managed correctly. These are the times that good operators really stand out. Their ability to buy right, execute on their business plan, solve problems, and have the means to fund a property there is a cash shortage make investors very happy. It was easy to do very well the last few years, and we've certainly benefited from that like many others. But a good operator can make a bad deal good and a good deal great. We'll see what shakes out this year, and it'll be interesting. Play the long game, be patient, and be conservative, and I promise it will pay off. Well, that's it for this episode. I hope you enjoyed it. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Asset Management Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and review this podcast, as it will help us grow our audience and reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website, breakofdaycapital.com, and sign up for our newsletter and or fill out our investor application. We'll talk to you next week.